Good morning. Time now a few minutes after 9 o'clock in the morning in Tokyo, Wednesday, February the 2nd, 2022. Welcome to online seminar organized by the World Bank and Asian Development Bank Institute. My name is Koichi Omori. I am Senior External Affairs Officer of the World Bank based in Tokyo. Okay, this morning we are featuring the latest edition of the Global Economic Prospect, which was released on January 11th, about 3 weeks ago. Global Economic Prospect, or GEP in short, is released twice a year in January and June. In fact, GEP is one of the most popular and well-read periodical report by the World Bank, making the largest number of the download among the many World Bank publications. We have established a good tradition to organize seminars for Japanese audience or audience in Japan every time the latest edition of the GEP are released. We are very much thankful to Dean Tetsushi Sonobe of the Asian Development Bank Institute and the colleagues of ADBI for this opportunity of collaboration and kindly agreeing to co-organize and make this seminar possible. Thank you very much. Let me introduce very briefly our speakers this morning. We have three experts from the World Bank in Washington and also Asian Development Bank Institute in Tokyo. Let me introduce firstly Ayhan Kose, the Chief Economist for Equitable Growth, Finance and Institutions and Director of the Prospect Group. Ayhan, good evening to you. Thank you very much for joining us. Can you hear me?
Thank you, Coach. It's great to be here, and I look forward to the conversation today. As you said, it's a great tradition, and I'm happy that we can remotely do it. But I look forward to the times we are going to be in Tokyo in person, interacting with our audience. Thank you.
Great. Thank you very much. As I have mentioned, he very much often traveled to Tokyo to present the JEP report in a face-to-face manner before the COVID. We definitely would like to have future opportunities to be able to host him in person once the situation is further improved. Thank you. Okay, secondly, we have Naotaka Sugawara, the Senior Economist at the Prospect Group of the World Bank. Good morning, Nao-san. How are you? Good evening to you, actually. How are you?
Thank you. I'm glad. I'm very honored and I'm very glad to present the JEP, Global Economic Prospects in front of this audience in Japan, as the usual in a sense. So I'm very happy to do this. And thank you very much for this opportunity. Thank you.
Great, thank you. Now has become a familiar face to many of you as he's a regular speaker along with Ayhan at the JEP seminars. Thank you. Thirdly, we have a pleasure of having John Beirne, a research fellow at the Asian Development Bank Institute, joining us as a commentator on behalf of ADBI in Tokyo. John, good morning to you. Thanks very much. Thank you very much for joining us this morning.
Yes, good morning. Thank you very much. It's a pleasure to make some comments on the report today, and I look forward very much to the discussion. Thank you very much.
Great. Thank you very much, John. We'll listen to keynote presentation by Ayhan and Nao, sharing the main point of the report in the next 40 minutes or so. Then after the presentation, I will ask John to share his comment on the report for 10 minutes. Following John's comments, I'll ask Ayhan and Nao to respond to John's comment immediately. Then I'll read a question from our viewers. Please send your questions during the seminar using online form posted on the announcement page for the seminar, or you can simply post your questions on the chat screen of the YouTube channel. I'll read your questions and ask speakers to respond during the Q&A time. With that, I'd like to formally ask Ayhan and Nao to start your keynote presentation. Thank you.
Thank you, Koichi, and good morning, all colleagues in Tokyo. It is great to be with you. We are in, of course, Washington, D.C. here. As I mentioned at the beginning, I'm looking forward to getting together in Tokyo, having an exchange with you. Let me thank again our colleagues in our Tokyo office, basically organizing this event always, and bringing the best and the brightest around institutions in Tokyo, this time Asian Development Bank Institute. And I would like to thank John taking the time joining us today. And I'm very pleased to have now Sugawara, senior economist in our unit and works on the report and many other analytical products with us. We have a presentation we would like to go over quickly. Let me share the presentation with you. Okay, I'm hoping that you can see the presentation. Global Economic Prospects report released in January and June every year. This year we released it 3 weeks ago. As usual, the report has outlook chapters, covering the global outlook and the regional outlooks in different emerging market, developing economy regions of the world. In addition, we have 3 analytical chapters. One covers commodity price cycles. Another one looks at the impact of COVID-19 on global income inequality. And a third one looks at the implications of recent multilateral initiatives for debt restructuring for developing economies in light of the lessons from the past episodes of debt relief. Now, and I will focus on 3 questions today. The first one is, what are near-term prospects for the global economy? And the answer is that we are in the midst of a pronounced global slowdown. That slowdown is taking place before the recovery from the global recession is complete in emerging market developing economies. So the recovery for emerging developing economies remains incomplete, but the global economy is slowing and slowing sharply. And downside risks still dominate the outlook. The second question I'm going to focus on, what are the main features of commodity price cycles? This is an important question, not just because of a significant number of emerging market developing economies are commodity exporters, but also because of we have experienced a truly historical bust boom cycle in commodity markets over the past 2 years. With the arrival of the pandemic, commodity prices collapsed, but then in a remarkable turnaround, they reached the historical highs over the past 6 months. And this has, of course, consequences for commodity exporters as well as importers. And one of the important implications of this chapter is that the nature of the cycles has implications for policy design. I'm going to articulate that. Then now we'll focus on the third question. What are the policy priorities for emerging market developing economies against this challenging background? And we are going to use this acronym throughout the presentation, AMDEs, that stand for emerging market developing economies. So let me start with the first question. What are near-term prospects for the global economy? Now, in a nutshell, we have a broad-based slowdown underway. Global growth will decline from 5.5 this year, 5.5% this, 5.5% last year in 2021 to 4.1% this year and 3.2% next year. Last year, we had an exceptional upturn following the collapse in 2020. That upturn was driven by unprecedented policy support and pent-up demand. This year, demand is dissipating and support is being withdrawn. Emerging market developing economies will also experience a slowdown as well, from 6.3% growth last year to 4.4% growth in 2023. Emerging market developing economies at the same time will have an increasingly more difficult external environment. As you see on the left, advanced economies growth will slow sharply. Global trade also will slow, and financing conditions will be tighter. Having said all of these, we will still see growth above potential globally and in advanced economies and emerging market developing economies. What is interesting here is that we will experience the steepest slowdown following a global recession during the modern era. When we look at the decline in growth between the first year of the recovery and the third year of the recovery following a global recession. As you see on the right, after 2009 global recession, we had a strong rebound in 2010, but then growth slowed sharply. So we ended up negative growth differential between the third year of the recovery and the first year of the recovery. In 1991 and 1982, two global recession years, global recovery gained steam after the first year. In 2021-23, following the 2020 global recession, we will see a historically steep slowdown. In fact, this will be the steepest slowdown since 1960, following a global recession. So what do the numbers look like? I already gave you the numbers for the world economy. For 2022, we downgraded our numbers for the global economy, advanced economies, and emerging market developing economies. This reflects our view with respect to, of course, the pandemic, as well as the dissipating demand and withdrawal of policy support. Now, when you look at the regions, you see that we downgraded our growth forecast in East Asia and Pacific. That was mainly because of we downgraded our growth numbers for China. We downgraded our growth numbers for the Europe Central Asia region. Their policy has been withdrawn faster than expected. And of course, the region has been going through a significant wave of outbreaks when it comes to pandemic. In the case of Latin America and the Caribbean, we also downgraded our growth forecast for this year. In Europe, Central Asia, and Latin America and the Caribbean, we see central banks are increasing interest rates to get ahead of the inflationary pressures. In the case of Middle East, North Africa, South Asia, and Sub-Saharan Africa, growth numbers upgraded. Of course, in the case of Middle East and Sub-Saharan Africa, that upgrade was driven by better than expected growth outcomes due to increasing commodity prices. But we need to also acknowledge the fact that as much as growth upgraded in Sub-Saharan Africa, the numbers still around 3.5, 3.6, 3.8. These numbers are not sufficient enough to push this region to the level to overcome still the poverty and mediocre development outcomes. So one of the important characteristics of the recovery is that it is still an uneven recovery, with richer countries performing better than poorer ones, reflecting different levels of policy support and unequal access to vaccines, which I am going to talk about soon. The chart on the left shows the magnitude of this unevenness. In contrast to advanced economies, emerging market developing economy growth trajectories are expected to be too weak to allow output to converge with its pre-pandemic trends. In fact, what you see on the left is that by 2023, advanced economies are going to go back to their pre-pandemic trend level of output. In the case of emerging market developing economies, output level is going to be 0.4% the 4% below the pre-pandemic trend output level. In the case of small states, it's going to be 9% below the pre-pandemic output trend level. Now, it is not just output. Of course, investment recovery also has been too weak to basically push the emerging market developing economies to get back to their pre-pandemic trend investment levels, as you see on the right. In other words, advanced economies are flying high. They are getting back to their pre-pandemic trends. Emerging market developing economies, they are flying low, and they are basically running out of steam because of their limited policy space. Now, this unevenness of recovery also manifests itself when we think about inequality across countries. As you see on the left, what happened during the last global recession was quite remarkable, because inequality across countries declined, in the sense that during the global recession, actually emerging market developing economies did reasonably well. And from 2008 to 2010, the inequality, irrespective of the measure you use, went down. When you look at what happened during the last global recession, 2020 global recession, inequality across countries has increased, because, of course, these economies were not able to put, emerging market developing countries were not able to put the type of fiscal, monetary, and financial policy support to overcome the pandemic. And of course, they did not have the capacity when it comes to health services to deal with basically the heavy load the pandemic brought on them. So, in addition to this between country inequality, we also had this very unfortunate outcome. After declining for 2 decades, we saw the extreme poverty increased for the first time in 2020, as you see in the middle panel. With the pandemic, we saw significant changes in basically distribution of income, even within countries, because lower income levels, the society with lower income, the segments of the society with lower income, informal workers, and a woman, these are the most vulnerable segments of the society, ended up having the largest income losses. That translated into, of course, higher inequality within countries as well, as you see on the right. Now, when you look at the driving forces of these changes in inequality, you see that a significant fraction of households reported income losses in 2020, and the fraction of households actually reporting income losses was higher in low-income countries. And when you look at the segments of the society that basically had higher likelihood of income losses, you see that informal sectors and the female workers tend to have higher likelihood of income losses, but those with tertiary education, so the more educated, tend to have lower probability of income losses in 2020. And when you look at access to government support, emerging market developing economies still much lower than what we have in advanced economies. They have much larger, of course, safety nets, much larger pot of government resources to allocate when it comes to providing support during a pandemic. In the case of low-income countries, things are even worse. Only around 12% of the households had access to government support. So against this picture, it is not all surprising to see inequality dynamics have gotten worse within countries as well as across countries because of the pandemic. Now, in light of this outlook, the risks are still quite significant and they are tilted to the downside. Given that we have a significant slowdown underway and there are multiple risks confronting emerging market developing economies, we see a possibility of hard landing in these economies in the sense that we might end up seeing even a steeper slowdown in emerging market developing economies if some of these risks materialize. What are those risks? Of course, the number one risk is new outbreaks associated with new variants of COVID-19. The Omicron variant translated into the largest wave of outbreaks and already putting a lot of pressure on health systems in many countries. We also see significant inflationary pressures driven by a wide range of reasons, including persistent supply bottlenecks, including increases in commodity prices, and still, in some cases, significant strength when it comes to demand side of the economy. Now, with these pressures, we see advanced economies are tightening their policies, especially the United States. And of course, with elevated debt levels already in place, there is the risk of financial stress. There are some other risks we need to be mindful of. Climate-related disasters threaten emerging market developing economies in different ways. And over the long term, we are worried about ending up even weaker than expected long-term growth. Let me briefly talk about these risks. As I mentioned, the Omicron already is putting a significant pressure on health systems. As you see on the left, the caseloads at the global level have been rising significantly, much larger than what we have seen in previous waves. But advanced economies are still taking the large share of the new cases. There are different reasons, of course, for that. The testing capacity plays an important role. The good news is that the significant impact, health impact of these new cases concentrated in primarily among unvaccinated individuals. When you look at the center panel, you see that in addition to European advanced economies, some cases, of course, the European emerging market developing economies as well, have seen a significant increase in caseload. At the same time, the Omicron translated into a milder disease, and there is all the hope that the number of new cases is going to moderate, has already started moderating in some countries, including, for example, South Africa, where the first cases were reported. Vaccination has been proceeding at the global level, with the number of doses administered exceeding already 8 billion. However, it remains highly uneven across countries. When you look at, for example, advanced economies, you see that around 80% of adults at least one vaccine dose already. In the case of emerging market developing economies, that number is around 60%. In contrast, only 10% of people in low-income countries have received at least one dose. While the low vaccination rates in low-income countries reflects procurement obstacles, efforts to rapidly scale up vaccinations are also being hampered by logistical challenges associated with distributing vaccines, including, of course, insufficient cold capacity in some cases. Global community needs to be much more active in helping these economies to accelerate vaccination programs and having a more structured distribution system in place. Let me focus some other risks I mentioned. One of them is inflation. Inflation has surprised on the upside in both advanced economies, particularly in the United States, and emerging market developing economies. This has resulted in steady upward revisions to consensus inflation forecasts, further rises in commodity prices, continued strong demand for goods amid more persistent supply constraints, and in some emerging market developing economies, sustained currency depreciations could compound these inflationary pressures. In some countries, more pronounced labor shortages, particularly in sectors facing strong demand and tight supply, including of course, when the economy is open, the services sector could further accentuate wage pressures. A prolonged period of upward surprises to inflation could cause consumers and firms to reassess their inflation expectations. Higher inflation, once embedded in inflation expectations, could weigh on consumer confidence and could erode real earnings. If inflation expectations rise above central bank objectives, they could also lead to potentially sharp adjustment of monetary policy aimed at a re-anchoring of expectations, posing a sudden rise in borrowing costs, particularly for emerging market developing economies. Now, when you look at financing conditions, in contrast to advanced economies, financing conditions in many emerging market developing economies have already tightened. This partly reflects policy rate hikes in a number of large countries as central banks grapple with rising inflation and currency depreciation. Of the nearly 24 emerging market developing economies whose central banks announced or implemented asset purchase programs in 2020 during the pandemic, 1/3 have already raised policy rates last year. In many countries, government bond yields have increased and sovereign credit spreads vis-a-vis advanced economy benchmarks have widened. Indeed, a faster tightening of financing conditions is another key risk confronting emerging market developing economies. In a context of high debt levels, a sharp tightening of financing conditions could make debt financing more difficult for many borrowers, including those emerging market developing economy sovereigns. As you see on the right, interest rate expectations for the US Federal Reserve have increased significantly in a short time period. And what the Fed is going to do in coming months will determine the evolution of financing conditions emerging market developing economies are going to see in global markets. Depending on the evolution of monetary policy, especially in the United States, we might see significant adjustments in these financing conditions, and that could be another impediment for the recovery of emerging market developing economies. Let me turn to the second question. What are the main features of commodity price cycles? Now, commodities are critical sources of export and fiscal revenues for almost 2/3 of emerging market developing economies. Dependence on commodities is particularly high for oil exporters, as you see on the left. The energy exporter, the average country, is more reliant on energy exports than the average, for example, agriculture and metal reliant emerging market developing economy. As you see in the middle, the prices of energy went through a truly historical episode in the last global recession and the following months. We conducted an event study to compare the behavior of commodity prices during the 2020 global recession with price movements around the previous global recessions and slowdowns over the past 50 years. And you see the result of this event studies for energy and metal prices here in the center panel and the right panel. During the 2020 global recession, the troughs in commodity prices generally coincided with those in economic activity. This is in sharp contrast with previous, more prolonged recessions, where commodity prices continue to decline for several months after the trough in economic activity. The collapse in the energy price growth during the pandemic was the steepest of any during global recessions in the past 5 decades, while the recovery in the price growth was the strongest, as you see in the middle panel. And as you see on the right, likewise, for the base metal prices, the pandemic-driven decline in 2020 was the steepest relative to the past recessions, and the recovery was also faster than in previous episodes. Of course, commodity price swings are nothing new, and in the report, we examine in greater detail the futures of drivers, the futures and drivers of prices for 67 commodities from the World Bank commodities price database. The average commodity price cycle took about 6 years, as you can see here in the left chart, with large booms, as you can see in the center, and smaller slumps. So it's very important to basically understand this. You see the duration of booms and slumps are quite similar, but during boom times, the price increases tend to be very large in absolute sense than what you see during slumps. These commodity cycles are highly synchronized across commodities and with the global business cycle. As you see on the right, on average, commodity prices were in the same cyclical phase as global industrial production 60% of time. Now, when we think about commodity markets, we also need to consider the energy transition that's underway and in all likelihood is going to be accelerating in coming years. As you see in the left two charts, renewable energy generation is considerably more metals intensive than traditional energy generation. And the right chart shows that hybrid and battery powered vehicles are much more metals intensive than those powered by internal combustion engines. As the energy transition unfolds, metals exporters may see strong increases in demand, and their economies may become increasingly resource dependent. In fact, metals are referred as the new oil in some circles. At the same time, climate change may well be accompanied by repeated pronounced commodity price swings, as we have been seeing over the past 6 months. That's a bit of what happened last summer when exceptionally hot weather in the northern hemisphere led increased demand for cooling. But the summer also brought a drought that reduced hydropower generation in China and lowered wind speeds in Europe that reduced wind energy generation. This sort of volatility may happen more often if investment in fossil fuels remains weak and while capacity in renewable energies is limited. In other words, in the chapter, we looked at these the cycles in commodities in the past. In all likelihood, these cycles are going to become more amplified as energy transition takes place and we see more dominant effects associated with climate change. With that, let me turn to now to discuss what are the policy priorities for emerging market developing economies in light of the outlook we described here. Now.
Thank you, Ayhan. I hope everyone can hear me. Yep. The third question we are asking is about policy priorities for emerging market and developing economy. So here is the list of priorities for policymakers in emerging market and developing economy. There's a wide range of policies, but broadly, we categorize them into 4 groups. The first one is, as we discussed, the dealing with outbreak of COVID-19 and the vaccine rollout. As in the previous slide, the vaccination in the low-income countries are quite lagging. So to improve the situation, the global coordination is significantly important. The second, the macroeconomic stability is related to controlling inflation and fixing limited fiscal buffers. And then third, emerging market and developing economies need to be prepared for future crises and strengthen growth prospects. For that, countries need to commit structural reforms to strengthen physical and human capital and access to health, education, and technology for better long-term growth prospects. And finally, they need to confront climate change and issues of inequality. In the next few slides, I will discuss specific policy issues. This slide shows the development and monetary and fiscal policies in emerging market and developing economies. As Ayhan mentioned in the presentation, there's a policy tightening underway. This is a critical factor shaping the outlook of emerging market and developing economy. But most importantly, this kind of policy tightening is well before the recovery in these emerging market and developing economy is complete. It's happened very early stage. So because of rapidly rising inflation, central banks in a number of emerging market and developing economies already increased the policy rate last year, as I have mentioned. Since the beginning of 2021, the average policy rate increased by 1 percentage point, and if China is excluded, increase was around 1.5 percentage points. The tightening is also happening in fiscal policy. About half of the fiscal stimulus in 2020 was already unwound last year in emerging market and developing economies. It will be a drag on growth in the majority of these economies over the coming years. for these elevated debt levels, a significant risk across countries, as Ayhan highlighted at the beginning of the presentation, and risks associated with this high level of debt are particularly high in the low-income countries. Actually, about half of them are fiscally constrained and already in debt distress. So eventually, some of these countries may have to resort to the debt restructuring, probably in a coordinated framework, such as the G20 common framework. In the report we are presenting, we look at past coordinated framework for debt relief, including the Paris Club, Brady Plan, EPIC initiative, including multilateral debt relief initiative, to draw some lessons from the past experiences. So in these previous experiences, debt relief was granted by multiple creditors, including those in the private sector, to multiple debtors' countries on common principles. So these principles, these initiatives offered substantial debt reduction, as you can see in the right panel in this slide. But typically, the processes were protracted. But these initiatives were typically preceded by less ambitious precursor initiatives. And the current G20 common framework has some similar features, especially because it primarily offers debt flow relief rather than the reduction in the face value of the debt. In addition, it is important to note that the future debt restructuring may be more complicated and challenging in the past. It is because of more fragmented creditor base than in the past. Go to the next slide, please. And one of the most important challenges facing the policymakers in emerging market and developing economy is the rising threat of climate change. As in the left panel, greenhouse gas emissions increased sharply in 2021, and they will increase this year as well. So governments, the civil society, and corporations, so all actors need to work together to accelerate progress in meeting the goals of the Paris Agreement on climate change. It should focus on reducing climate change's economic, health, and social impacts on the most vulnerable. And as in the right panel, addressing the challenges associated with the transition towards renewable energy source also remains an issue. Specifically in commodity exporters, the transition away from fossil fuel to low carbon technologies will have a significant long-run implications. Consumption of renewable energy has increased sharply over the past 2 decades, and it is expected to increase further in the future. Producers of fossil fuels are likely to see a decline in demand on their export, which could lead to a fall in the fiscal revenue and the deterioration in the terms of trade in these economies. In contrast, producers of commodities used as input in the green sectors are likely to benefit, particularly some metals exporters, as I have mentioned in the presentation, as renewable technologies are metals intensive. Thank you, Ayhan.
Thank you. Now, let me summarize what we have said so far. The first question we focused on: what are near-term prospects for the global economy? A pronounced global slowdown is underway before the recovery is complete in emerging market developing economies. And there are multiple downside risks to consider as we basically enter into this new year. The second question we focused on: what are the main features of commodity price cycles? And what we documented is that these cycles experience often larger booms than slumps. And that has, of course, important implications for the formation of fiscal policy, the countries need to take advantage of these larger booms and smooth the cycle during the periods of slump. There's growing price synchronization across energy and metals that's driven by global demand shocks. In all likelihood, we will see more pronounced cycles driven by energy transition and changing climate. The third question was, what are the policy priorities for emerging market developing economies? And the first priority is still controlling the pandemic, ensuring macroeconomic stability, and of course, overcoming the long-term challenges with respect to development objectives. That will require improving debt sustainability, that will require enhancing preparation for new potential crisis, improving resilience to commodity shocks, and of course, confronting the challenge of the climate. There are other important challenges associated with gender and income inequality, as we documented, that has increased during the pandemic. None of these things can be done without the help of the global community. And global community needs to provide help for the emerging market developing economies in the context of debt relief, as well as in the context of broader development needs, especially when we think about the needs of these countries when it comes to confronting the climate change. Let me stop here, but let me also invite all of you to visit our webpage for the Global Economic Prospects Report, as well as the Commodity Markets Outlook and our monthly publication, Global Monthly. We have done a significant amount of analytical work in the context of inflationary developments, as well as, of course, issues related to debt. Thank you. Back to you, Koichi.
Thank you very much, Ayhan, and now for your keynote presentation. Really appreciate it. Now I would like to ask John Beirne, a research fellow at the Asian Development Bank Institute, to come in and then to make his comment. John, please. Thank you.
Thank you very much, Koichi. Yes, allow me to just share my screen. For that, Koichi. So it's a pleasure to provide comments today on this World Bank Global Economic Prospects Report. I think it's a very rich report, and it provides details on a very wide range of issues, which is of course very challenging at the moment. So the comments that I have, I hope that they will be useful for subsequent editions, and I also have some questions on the content of the current report as well. So can you go to the next slide, please? So the report is essentially structured around three main challenges faced at the global level today. The first one is on the large macroeconomic imbalances that have emerged over the past few years, and this is closely linked to high levels of debt, widening fiscal deficits, of course, and expansions in central bank balance sheets that we have observed in the pandemic period. At the moment, we're moving into a tightening policy cycle, particularly on monetary policy in advanced economies, and the implications of that for emerging markets are something that is considered in the report. And this, of course, raises concerns for financial stability and related implications for exchange rates and inflation dynamics looking ahead. The second main challenge looks at income inequality, both across and within countries. So due to the pandemic, we have had rises in poverty. On the other hand, we have seen in more recent months inflationary asset price booms as equity markets, for example, have recovered. And this has all had implications for rising inequality at the global level. The third main challenge is on economic uncertainty, which has been a feature of the global economy in recent years, of course, with supply chains impaired, and in more recent times, higher volatility in financial markets and in particular in commodity prices. So these are the main challenges that are highlighted in the report. If you go to the next slide, please. So to address those policy challenges, an agenda is put forward in the report. The first one is structured around dealing with the debt situation. So advocating concerted efforts towards mobilizing external resources in this regard. The second policy issue is structured around improving domestic growth through innovation. So measures aimed at promoting inclusive and sustainable growth going forward through issues such as digital transformation, which is a cross-cutting theme across many sectors, of course. Investment in infrastructure is key. Climate adaptation and promotion of clean energy is also something that is important looking ahead in terms of sustainability, as well as that continued development of local financial markets, particularly in emerging economies. So that's the second broad policy agenda advocated in the report. And thirdly, on food security, important insights are provided here in the report, particularly in relation to fragile and conflict-affected countries. And of course, there are complications here linked to volatility in commodity prices and climate change. And all of these are horizontally touched on throughout the report. So if you go to the next slide, please. So my comments are fivefold. So there are 5 main comments, and I'll go through them now. So the first one is on global inflation and medium-term risks. So as the report rightly points out, we've experienced a rise in inflation during 2021. However, I think that to a large extent, many of these inflationary developments are transitory in nature during 2021 at least. So the question is, to what extent we should be worried about these developments? As is noted in the report, the medium-term inflation expectations are broadly anchored. So I think it would be very useful for some deeper analysis on inflation developments, also across regions, and in particular looking at differences in supply and demand factors underpinning those inflationary factors, and to what extent we would see potentially de-anchoring of inflation expectations over the medium term. So that would be on global inflation. On commodity exporters versus importers, I mentioned previously that the report looks at the issue of volatility in commodity prices. I think a large portion of this analysis is focused, understandably so, on exporters, but there are different dynamics at play for commodity importers. So that would warrant some further analysis. For example, there would be a consumption risk dimension there that could be delved into a little bit further. Second comment relates to global monetary policy spillovers during recovery. Of course, the report notes the tightening cycle in the US and the potential that that can have at the global level. I think it would be important to delve a little bit deeper into that. For example, inflation-motivated tightening has potentially different effects than growth-motivated tightening at the global level, whereby growth-motivated tightening can actually have a positive effect abroad, given the trade channel, which would be boosted as a result of growth enhancement in the US. Whereas more monetary related factors, such as those motivated by inflation, can have potentially destabilizing effects. So I think at the moment we're in this scenario whereby tightening in the US is inflation motivated, albeit for transitory as opposed to more longer term factors. But I think that over time, growth motivated tightening in the US may actually have positive effects abroad, given that the trade effects for emerging markets may outweigh any potential negative effects that would come from financial channels. Third point is an important one on debt sustainability and the coordination of fiscal and monetary policy. I think that the report devotes a lot of focus on debt issues, at least, also having a special feature within the report devoted to that. I think that it would be opportune to go a little bit deeper on that issue, in particular as regards fiscal governance options ahead. As we know, credibility in fiscal rules is an important buffer against negative external shocks, and there would be a need to adjust some of the fiscal rules that are in place at the moment going ahead, also bearing in mind the monetary policy stance. I think that possibly for subsequent reports, this could be something that could be delved into a little bit deeper. Similarly, fiscal multipliers have different impulses depending on interest rate growth differentials. And of course, there's a lot of cross-country heterogeneity on that differential at the moment. But I think that further analysis on that issue would be extremely useful from a debt sustainability analysis point of view. On debt restructuring, so the special feature on debt in the report, I think it's mostly a descriptive piece, but I think that more could be pulled out of that in terms of where restructuring should focus on. So towards capital expenditure and sustainable infrastructure, for example, and also how do we really get private sector participation in this? This is something that is lacking in the G20 common framework, and obviously it's a very difficult issue, but the report slightly touches on that, but I feel that given the importance of the issue, it would be useful to delve a little bit deeper on that one. The final point on debt relates to, well, as we've seen in recent years in some emerging markets, we have an issue of shorter duration of local currency debt. And this creates financial stability risks in terms of rollover risks associated with this debt, and obviously the sensitivity that would have to rate rises. So I think that's an important financial stability risk that could come out of the debt analysis. The next slide, please. So my fourth comment is on economic uncertainty. So as of course is rightly reflected in the report, economic uncertainty is a key issue which feeds into policy across the board. It's still prevalent for 2022, but it would be interesting to understand a little bit which factors are dominating. So is it uncertainty on growth, inflation? All of these factors are intertwined, of course, and also they are intertwined with the pandemic. But rather than just saying we have economic uncertainty, I think it would be important to understand the relative economic uncertainty that we have at the moment compared to previously, and to understand a little bit the differences in the factors driving that uncertainty. Some examples are provided there. So we have financing conditions which are extremely uncertain at the moment, given monetary policy tightening cycles abroad in advanced economies. External debt vulnerabilities in emerging markets, depending on their level of exposure to foreign currency, for example. Capital flow developments are also an issue, which actually is not touched on very much in the report. In general, I would say that the report is more heavily weighted towards the real sector than the financial sector, but maybe that's by design. So that's just something that I noted, that financial stability risks are not weighted very much in the report compared to risks to the real side. Finally, on digitalization, this is mentioned as a key challenge and an important policy area ahead. However, there's little analysis of this within the report. I think there are obviously issues around that regarding data availability, particularly over a long time series. But I think not only for the World Bank, but for all institutions, I think that it would be important to empirically understand the effect that digitalization has on economies at the global level in terms of productivity, competitiveness, and also financial inclusion. And these types of issues that are consistent with a sustainable recovery and sustainable development. So this is perhaps something for future, data permitting, In the next few slides, please, Koichi, go to the next slide. In the next few slides, I have just a couple of quick issues that I would like to mention in the case of Asia. So the report also has regional focus pieces within the main document. And I think it would be useful to go a little bit deeper on the resilience of Asian economies to external shocks. For example, we have here some evidence to show that Asian economies are more resilient to external shocks due to less overvalued exchange rates relative to the past. So they're less vulnerable to sharp exchange rate depreciation simply because exchange rates are more in line with fundamentals compared to the past. And also current account positions are more favorable. And there's overall a less reliance on foreign financing, which of course is important. And we saw during the pandemic that Asian financial markets were quite resilient relative to other regions. And this is an important factor which could be drawn out, I think. Next slide, please. I mentioned about the issue on financial stability risks not being a major feature of the report. Perhaps this is due to the design of the report and its objectives. But that said, I still think there would be scope to mention some issues that might be important from a financial stability perspective, because of course they can spill over to the real side. And one such issue relates to corporate debt exposure in emerging Asia and its increasing trend in recent years. And in conjunction with the tightening US monetary policy situation, this can pose a financial vulnerability ahead and warrants further monitoring. And finally, if you go to the next slide. So the final slide is on fiscal risks and climate risk. So the issue of climate change and climate risk is a solid feature of the report, I would say. I think there would be scope to intertwine the findings from the climate change analysis more into the other elements, notably the macroeconomic side. Here I provide an example on the implications of climate risk for the cost of sovereign borrowing, which can of course have implications for debt sustainability. This is just one example, but I think given the cross-cutting horizontal nature of climate change and its worsening effects, I think there would be scope to incorporate that into other parts of the report as well. So thank you very much, and that concludes my comments on the report. Thank you very much.
Application share.
Thank you very much, John, for sharing your comment to the report. Now I would like to ask Ayhan and Nao to come in to respond to the point raised by John, particularly 5 points that he raised towards the end of his commentary. But I would like to ask now Ayhan and Nao to come in to respond. Thank you.
Thank you, Koichi, and let me thank John for really providing these insightful comments, and I agree with what he said. I think there are a number of issues that could be delved into and that could be extended. But let me go over the specific issues John raised. The first issue is about global inflation and the medium-term risks. The question is that how we think about inflation in the near term and then medium term, especially in the context of emerging market developing economies. In this report, this edition, we discuss these issues, especially in the first and the second chapters. In the June report, actually, we released a full analytical study about evolution of inflation and the impact of the pandemic and our expectations going forward. I'm not going to use this term whether this inflation transitory or permanent. Inflation surprise on the upside. It ended up higher than what we expected in June, slightly higher. And there are still factors that can keep inflation high for the foreseeable future. We are expecting some of these pressures to dissipate in the second half of this year as demand moderates and supply side disruptions basically become more manageable. Having said that, in the context of emerging market developing economies, these inflationary pressures have already been putting policymakers in a corner. Short-term inflation expectations picked up in these economies. Relative to 2020, we saw a pickup in 2021 as well as in 2022. As I mentioned during the presentation, to get ahead of these inflationary pressures, emerging market developing economies, many of them, have already increased policy rates. This was not surprising because for the majority of inflation targeting central banks, emerging market developing economy central banks, now inflation is above target. More importantly, when we look at the long-term inflation expectations, while for the median emerging market developing economy, these expectations remain stable, for some emerging market developing economies, we saw long-term inflation expectations also started creeping up. In South Asia, in Europe, Central Asia, in Latin America and Caribbean, many economies saw meaningful increases in long-term inflation expectations. And in those regions, central banks actually were aggressive, many of the central banks, in terms of increasing their monetary policy rates. In the case of Middle East, North Africa, in the case of East Asia Pacific, we did not see the type of inflationary pressures we saw in these three regions I mentioned. So in an environment, you have these inflationary pressures, and still there are challenges in terms of anchoring long-term inflation expectations in many of these economies. We see significant room for policymakers to react. John mentioned a number of factors one has to take into account, including supply bottlenecks, labor shortages, high energy prices. There are good reasons why we should continue expecting some of these factors keeping inflationary pressures alive for the foreseeable future, as I mentioned. During the next 10 days, we are going to release a column explaining our views with respect to inflation and inflation expectations in emerging market developing economies. The second issue John raised is probably the single most important issue when it comes to risks confronting emerging market developing economies. That is global monetary policy spillovers. As John described, we need to think about the underlying source of the increase in policy rates in advanced economies. In this case, there are basically significant inflationary pressures for the US Fed to react. And we are expecting the Fed to react and increase interest rates at least 3 times, maybe 5 times this year. Each time 25 basis points. If that happens, this can be a still manageable tightening cycle for emerging market developing economies. But if we see a much faster, more aggressive tightening cycle, that could lead to more tighter financing conditions, and that could basically be a threat to some emerging market developing economies that have high levels of foreign currency denominated debt and that have basically significant challenges in servicing their debt. In the context of debt sustainability and the coordination of fiscal and monetary policy, as I tried to show in my last slide, over the past 6 months, we have done extensive studies and released multiple papers. In fact, some of these papers now and I worked on together. In the context of financial stability concerns, most of these concerns are about, of course, debt issues. John acknowledged that. We released 3 major studies. In the context of inflation, we released 2 studies, and all of these are available on the web page. And I agree completely with John. These are the types of risks we need to monitor and study and think about the consequences with respect to an external environment, how that external environment basically combined with the vulnerabilities in emerging market developing economies translate into certain shocks materializing and amplifying the challenges these economies have. With respect to economic uncertainty, the good news is that there is less uncertainty today relative to 2 years ago. 2 years ago in March, we had a basically beginning of the pandemic, and we couldn't see the kind of the next month clearly because we were really in the dark with respect to evolution of the disease. We shut down the economies. Now, at least we have a pretty good idea how to manage the pandemic. We have vaccines available, therapeutics coming in line, and there is this hope that the economies are going to open soon. But there are a number of reasons that make the environment very uncertain in the context of this transition. One important transition we are going to see, as I mentioned, the tightening of monetary policy in advanced economies. These tightening cycles, when they are driven by inflationary pressures, translate into significant challenges in emerging markets and developing economies. Accidents can and do happen when advanced economies basically increase their policy interest rates. That makes the environment very uncertain for emerging market developing economies as they are trying to see basically the future with respect to policy formation. In this context, it's going to be critical for advanced economy policymakers to communicate their intentions, to basically pin down the parameters of their reaction functions and explain that in a way that is well-defined and informative. In the case of emerging market developing economies, of course, they need to make sure they have the reserve buffers and the monetary policy and fiscal policy frameworks in place to see the kind of the tightening cycle. Let me mention the capital flow issues. Capital flows declined significantly, especially in the context of equity flows to emerging market developing economies. Bond flows are still there and significant bond issues. Foreign direct investment has been weak and remained weak, of course, last year. These issues we discussed in different reports and of course the financial sector issues we discussed extensively in other publications of the bank. But let me stop here and turn to Nao if he wants to address some of the issues John mentioned. And let me thank again John for his detailed feedback.
Yep. Thank you very much, John, for your comment, the detailed comment. Then let me answer this question on this digitalization first, and then I add a little bit more information on the question on your comment on that. So digitalization, yes, this is a very important source of the productivity growth. You know, if this is sustained over a long time period. Also, this digitalization could lower operational and other, firm costs, which contribute to the reducing the informal sector in these farm level informal sector in these economies. But it's important to note that it could also increase the income inequalities because of this digitalization, because it depends upon who can use it, and who cannot use, or who has access, who does not have access to it, especially for those with the lower end of the income distribution. So it's the digitalization is very important, but at the same time, we also need to be more careful on how we implement those digitalization policies. So that's a response to digitalization. And then in terms of the debt, so we mentioned in the presentation that there's a fiscal stimulus is going to be unwound over the coming years, but we expect that debt level still elevated. That's because that's one of the reasons is that there's a loss of revenues. So their revenue collecting capacity is going to be lower in the emerging market and developing economy. So as you mentioned, this revenue mobilization or like a broadened tax base is a very important point. And then in a paper this Ayhan mentioned on the debt issues, we conducted an event study showing that in the past global recessions, after the past global recession, debt level are going to increase. So like in the 2020 cases, we don't have much information, but we might be seeing that there's a debt level still increasing or a high level is kept for a shorter or a medium period of time. So those are I would like to want. Yeah, thank you very much again, John. Thank you very much.
Thank you, Ayhan, and now for your responses to John's comment. During the seminar and also in advance to the seminar, we received questions and comments from our viewers. So let me read those points, questions and points raised by our viewers comprehensively and ask Ayhan and now to come in to respond. And probably John also may want to make some comment. And then we wrap up a seminar for the rest of the 10 minutes. So let me read those questions. First, question from Sasaki-san. Thank you for your question as always. What do you think of the role of technologies to push economic growth in developing countries? Engagement of the private sector in advanced countries must be the key in this regard. Also, stable recoveries in emerging countries such as India and China must follow. Any comments would be appreciated. That's the question from Sasaki-san. Thank you for your comment. Secondly, we received a question from Pradeep Pandey of the ADBI. Thank you for your question. It seems that the movement of institutional quality in emerging economies are unusual due to COVID-19 pandemic in 2020 around the world. However, most of the emerging economies have improved their overall institutional quality to overcome COVID-19 challenges, especially rule of law and regulatory quality have been improved. Does this indicate some fundamental changes on governance which may change global economic outlook concerning the macroeconomic stability in the next 2 years? Pandemic have changed financial vulnerabilities of many emerging economies too. What lessons have we received in the last 2 years regarding institutional development in emerging and developing economies? Thank you for your question and comment, Pradeep. I really appreciate it. Next, we received a comment from the Professor Naoki Yoshino. Thank you very much, Yoshino-sensei, for your points. 2 points. Income inequality partly comes from tax evasion by rich income group. Proper tax collection together with transfer to poorer group would be needed. And then his comment, government policy would be better encourage private financing in order to help big burden to the government facing with high accumulated debt. Infrastructure encourages PPP. There must be many government expenses where private financing could come in. Those are the comments by the Yoshino-sensei. Thank you for your comment. And then question from Mr. Kiyoshi Kodera. Thank you very much, Kodera-san, for your point. Ayhan, thank you very much for a timely and balanced analysis. China's slowdown is mentioned. do you incorporate risk of China's continued zero COVID policy and its negative supply chain impact to global economy? What do you assess such risk? So these are the points raised by our viewers. I'd like to ask Ayhan and Nao to come in to respond to some of those points. Thank you.
So thank you, Koichi, and I'm happy to learn that we have colleagues and many friends watching us and sending questions. In the context of these very interesting questions, let me quickly provide quick responses. Sasaki-san asked about the importance of technology. Of course, the technological change is critical for growth, and it's the main engine of growth and main difference when you look at the the variation in income across countries, mostly attributed to the variation in productivity growth, of course, driven by technological change. As I mentioned in this presentation, there are important things national policymakers have to do to address many of these risks we mentioned, many of the development challenges we discussed. There are certain things advanced economies need to do in terms of helping developing economies, especially lower income countries. Let me briefly talk about those. First, as many of you know, we recently completed a very successful replenishment of International Development Association funding. We are greatly appreciative of global community, and let me here thank Japanese government for its generosity as well. When it comes to the most unfortunate segments of the global economy, the low-income countries, members of IDA. That has been a welcome development, and at the World Bank, we will use the resources IDA to the maximum effect to help these economies and deliver the results we basically promised in this round, and have these economies make significant progress when it comes to development. Beyond that, there are important challenges, especially in the context of equitable distribution of vaccines, the distribution of vaccines taking place in a systematic manner, so vaccines go where they are needed. And then, of course, in the context of debt relief efforts. Now already mentioned the challenges in the context of common framework. We need to find ways to improve the common framework. There is no question about that. And in the context of climate change, many of these countries do not have the financing to overcome the challenges associated with climate change. So the global community needs to provide help. Sasaki-san's question focused on the technology. We are hoping that we will utilize the resources we have in the World Bank to improve the technological progress and the productivity growth in low-income countries. Pandip's question is very interesting when it comes to institutional quality. Of course, probably we have seen significant improvements in the context of service delivery during the past 2 years. Given the pandemic and the challenges associated with the pandemic, governments stretch their resources, their ability to deliver certain health services, and the hope is that there are significant lessons associated with that. In addition, delivery of educational services have been going through a significant change, and the hope is that these changes will translate into better outcomes. But of course, we need to wait and see the kind of the outcomes, whether those outcomes will be helpful when we think about the medium-term and long-term developmental objectives. Now, whether we saw a significant change in the context of quality of governance, that has also need to be seen. Financial vulnerabilities in every sense have increased, and those vulnerabilities today are larger than the vulnerabilities in 2019, prior to the pandemic. That brings the issue of institutional frameworks, policy frameworks, and the importance of those frameworks. Yoshina-san talked about the issue of income inequality and the need to basically improve the revenue base and making sure that there is no leakage when it comes to collection of taxes. And there is no question, this is an issue we need to spend more time. Domestic revenue mobilization in advanced economies, as well as emerging market developing economies, critical given the fiscal challenges these economies have. And there are many things we need to do in the near term, and we have an aggressive, comprehensive work program, especially for developing economies, to expand the base when it comes to revenues. The private sector financing is, Yoshina-san, critical to address many of the challenges when we think about emerging market developing economies. That financing requires having strong institutions, basically mitigating the risks we discussed today. And there, of course, we have our private sector arm, International Finance Corporation, working private sector, as well as the World Bank and MIGA providing significant support. And we are well aware of the fact that the public resources are quite limited when we think about the climate change, when we think about the infrastructure needs, when we think about the needs in the context of health sector and the education sector. And in all of these, private sector financing going to be critical, and the combined forces of private and public sector will be the main driving engine when we think about how we can find solutions. Kodera-san asked this question about China. Let me briefly talk about our the forecast in the context of China. So China registered significant growth last year, around 8%. This year, we are expecting Chinese growth to be around 5.1%. This was a downgrade, 0.3 percentage points relative to our forecast in June 2021. The downgrade was driven by, of course, the challenges in real estate sector and some of the policy interventions and the withdrawal of policies. But at the same time, Chinese authorities are well aware of the slowdown and the risks in the real estate sector, and they have been undertaking measures to address these issues, as we have seen over the past 3 months. Next year, we are expecting China to grow around 5.3%. However, we look at it, slowdown in China relative to the levels we have seen in the past 8-10% high digits will have consequences for emerging market developing economies. We have a work program looking at these spillovers from large emerging markets to other developing economies, and we plan to release a study in coming months on these issues, including in the context of the Global Economic Prospects report. There are risks associated with any type of policy countries are implementing in the context of the pandemic, but at the end of the day, these are national choices, and our hope is that these national choices are informed by scientific evidence and are effective on the ground. But let me stop here and turn to Now and John, whether they would like to add anything to the questions from the audience.
Yep, thank you, Ayhan. I would like to add just one point for the question on the technology. I would like to highlight the importance of the regulatory environment, such as property right in this case, for technological development and the use of its use in the economic growth. In addition to this, the role of private sector in advanced economy and then stable, emerging market growth. To make the best use of this technology to economic growth, regulatory environment or regulation must be eased for this friendly to private sector development. Otherwise, there's no way to use for this technological development for economic growth in this low income or developing countries. That's what I want to add. Thank you.
If I could just add 2 quick points. So firstly, on the question regarding institutional development, I think that this is an important point, and it's certainly to be encouraged. But what one consider is that for these impacts of institutional development to be realized on economic growth, it's more of a slow-moving sort of an effect. So over the longer term, we would certainly expect to see positive impacts on economic growth, but not over the shorter term, of course. And that also links to encouraging types of capital flows, which would be longer term in nature. So this is something that we would be looking ahead to. On the question about technological development, just in addition to what has already been said, I think this is an important point and will certainly drive competitiveness of emerging markets going forward. But there are issues around the need for digital investment, digital infrastructure investment, as well as digital education, and also issues around ensuring risks related to cybersecurity and financial stability are mitigated in this regard, reflecting also what Nao has said. Thank you. That's all from my side.
Thank you very much, Ayhan, Nao, and John, for your responses to the point raised by our viewers. I really appreciate it. Thank you. So in order to close and wrap up a seminar, I'd like to ask, in order of John, Nao, and Ayhan to make very final remarks, including your messages to the audience, etc. And then we wrap up a seminar. So John, any final words from you? Thank you.
I would just thank everybody for the discussion today. I learned a lot from reading the report, and it was a pleasure to provide comments on it. And I look forward to reading the next report, I believe, which is in June. Thank you very much.
Thank you. Nao-san, please.
Sure. Thank you very much. Yeah, thank you very much for this opportunity. Again, it's very. I'm enjoying and presenting the global economics prospects and then this its result. And then thank you very much for John for this very detailed comment. It's very helpful. Stimulating. So, thank you very much again for this colleagues in Tokyo and colleagues in the ADDI. Thank you very much for this opportunity.
Thank you. Ayhan, please.
So, Koichi, let me thank you once again organizing the event, and I'm also sending my greetings to colleagues in Tokyo office. I'm wishing everybody a safe and healthy year. 2022. The outlook obviously has many challenges, but as I mentioned, we are in a better position when it comes to pandemic, and I'm hoping that we will be in a better position in the context of the pandemic next time when we talk about the global economy. And I'm happy that Nao joined me today again. And I'm very appreciative of John and ADBI Institute for joining us at this forum. Best wishes to everybody in the new year. Thank you, Koichi.
Thank you. With us this morning, Ayhan Kose, Chief Economist for Equitable Growth, Finance and Institutions, and Director of the Prospect Group. Also, Naotaka Sugawara, Senior Economist at the Prospect Group of World Bank. And we had a pleasure of having John Beirne, Research Fellow at the Asian Development Bank Institute, as a commentator. Thank you very much, 3 of you. Really appreciate it. Thank you. We have interesting online seminars coming up. As usual, please check our website for the latest information. With that, stay safe, stay healthy, and see you next time. Thank you.